We're not even out. Oh, there we go.
We're on.
All right. Bad hamstrings, Memorial Day.
Hammies. Moon's over my hammy.
All right. How was a long weekend?
Long weekend was great. Wish we had better weather, but Monday turned out to be beautiful. Oh my God.
That's the worst part about the long weekend when it's the week, the return day.
Yeah, this is the best day you got.
Yeah, but I stayed up Monday, drove home Tuesday. I was like, I think everyone else decided they were staying up north. On Monday.
Monday the lake got crazy.
Yeah, there was it was Crazy Lake and a 2-hour drive from Spring Grove back to Mokina. The mud turtle, I believe, is the Indian language for that.
Is it really?
Something along those lines.
What do we got today, Junior?
I figure, since, we probably got a little hangover recovery type stuff, and I didn't bring a hat, we'll just pick some questions that I've been asked in the last month.
Ooh.
And see what comes up.
I'll go first.
All right.
Best way to be prepared to buy.
Ooh. I would say scheduling a 30-minute conversation with my group, and we can answer all of your questions. The biggest ones would be understanding your budget, how to calculate mortgage payments. Do I have enough money saved?
What can I afford to buy?
Yep. Affordability is going to be a big one. How does it work? I think there's a lot of first-time buyers that are maybe confused or maybe don't understand that, you don't apply for the mortgage and get the house, you don't get the mortgage tomorrow. There's a little bit of a process there.
Takes a while.
What other questions would you have? If that was you that wrote that question, which it might have been.
It could have been. I would just say anything I shouldn't do between now and when I want to buy, anything I should be doing, just like behaviors that work and don't work.
Change, ideally don't change jobs, but if you're going to change jobs, it's not a big deal. We have a client that's going through that right now. Hey, I just received an offer for 27% more income. Is that going to impact me? I was like, that's actually going to help you out a bit.
Yeah.
So I don't have to work there for 2 years? No, you don't.
Yeah, that's a common misconception.
Big one. All right.
Next question. Hot seat. Junior, what can kill my deal before closing?
Ooh, that's some great handwriting on that.
Yeah.
Things that can kill your deal. That's a good question, Adam. Taking on a bunch of new debt, undisclosed liabilities that pop up during the underwriting process. What I think a lot of buyers don't understand is that Fannie Mae and Freddie Mac, the big or whatever you want to call them, GSEs, that they require mortgage companies to have a QC process.
QC, quality control.
Quality control, yes, sir. And so if your loan is going to be like a maximum LTV and your debt to income ratio is going to be a little bit higher, we have active undisclosed debt monitoring throughout the process. So if you inquire for that, that Memorial Day appliance sale, and you open up a Lowe's credit card or Menards credit card, we would get alerted, and then we have to get your file back into underwriting to make sure that you can support that debt load.
That makes a lot of sense. So just don't open new accounts, right?
Yep. Don't deposit large sums of cash
unless you have a reason for it. Even if you don't?
Even if you don't, I don't recommend cash. Have a conversation with your mortgage person. They'd be able to walk you through what you can and can't do with that.
Okay, here we go. On the hot seat. PMI versus 20% down. What's better? Why?
Ooh, that's a good one. I would tell you that if down payment is your biggest fear or your biggest hurdle to entering the home ownership or buying a house, PMI is not as scary as it once was.
Yeah.
It's an industry just like most other financial services industries that's consolidated. It's gotten more transparent, more honest. And if you have strong credit, so if you're in that 740 plus range, there's generally, I think, 6 or 7 PMI companies left in the country. They are clamoring for your business.
They want it.
They're going to be
competing with each other.
Yes, they're going to be cutthroat. I actually had this conversation with the guy on Thursday afternoon. I saved up all this money to put 20% down. I'm like, if you put 20% down, how many months of mortgage payments are you going to have in reserve after that? He said 1. I was like, well, if I told you the PMI on this transaction was going to cost you, it's a $225,000 loan with really great credit. So if you put 15% down and PMI might cost you $14 a month, would that make more sense that you had 6 months of mortgage payment saved?
Yeah.
And he's like, oh, absolutely.
I don't think people have an understanding of how important an emergency fund is. It is literally your last barrier to could potentially financial ruin. And there's, experts talk about, well, how much should he had saved? And think about it, and you should think about it in terms of months of expenses, not a dollar amount.
Yeah, that's the biggest thing. What do you think, in your opinion, what is the right?
I think it depends on your stage in life. So if you're getting ready to retire and you're 5 years before that, you should have 2 years of cash, in my opinion. If you're just a young family, I'm thinking like 6 months in cash is probably a good place to be, but it also is a very personal number. It's what does it make you feel safe? But to finance that or to just go down to 1 month, I mean, what happens if
that was 1 month of mortgage payment? That's not other expenses. Yeah, I mean, I personally firm believer in the 12-month of monthly savings. I work in a volatile industry, erratic cash flow. You own a business, like it's that stuff. But I would say that bare minimum should be 6 months.
Yeah, interesting, and that buys you time, right? Because if you lose your job or you get hurt, and then what happens is you get a little desperate, right? Because you got to make those bills. And what do you end up doing? You end up taking a job that's below you, and you're paid less for the next decade than if you would have had time to just wait for the right opportunity. So PMI could be a little weapon in that arsenal.
I like that.
Didn't even think about it that way. All right. So how much house can I afford?
For you, $1 billion.
$1 billion.
I think the easiest way to look at how much house I can afford, if you like, from a mortgage qualification perspective, right? Because we're qualifying on gross in, like if you're W-2 gross income before taxes.
Yes.
So you have to factor all of that in. But if you just said, okay, I make $120,000 a year, that's $10,000 a month. Multiply that number by 50%, that's $5,000. Back out your consumer debt, so car payments, student loans, credit cards.
Okay, so now we're down to 3 or 4, right?
Yep, and that's generally what the book says from a mortgage perspective. You're gonna be able to qualify.
Right.
That's the easiest, like the fastest math. But I tell people this all the time, like the whole getting ready to be being prepared to buy. Pretend like you have the mortgage for a month or two. Can you set that money off into like a savings account?
That's great advice.
And see if I can live with whatever's left, right?
Right.
Practice run. Okay, I'm paying $1,500 a month in rent. I want to go to a $2,500 a month mortgage payment. All right, so I make my rent for $1,500. I put $1,000 off to the side that I don't want to touch. Can I do that for 2 or 3 months and still feel comfortable?
Yeah. So you're saying simulate it.
That's amen. Like it's hard to, good properties are hard to come by right now. So you have time to practice this, and that way you're comfortable with it. Because what's going to happen, you're going to find that house, right? And then the emotional roller coaster, everything starts going up like this. You multiply emotions in finance, can get slippery real quick.
No bueno.
Yep.
Okay, we got 2 left. This looks like the juicy one. ARM versus fixed.
Ooh.
Adjustable rate mortgage.
Oh, I thought you were talking about ARM. That's a very, very interesting one. So let's talk about ARM. Like, what is an ARM, right? There are adjustable rate mortgages. So what they typically are, they're hybrid ARMs. So they'll adjust after 3 years, after 5 years, after 7 years, or after 10 years.
What do they adjust to?
That's a great question. So they used to be based on this thing. They used to go index plus margin. So index is whatever financial data it's tied to. For the longest time, it was LIBOR, the London Interbank Offering Rate. Turns out that was rigged. So yeah, they changed it now. And now it's usually a cost of funds index or maybe a constant maturity treasury, one of those.
Okay.
That's your index. And then the margin is the premium that the lender assigns on top of that cost of funds basis or the index. And then that's your interest rate.
Okay.
So biggest thing though, so a 3-year ARM, fixed for the first 3 years, then adjust in 6-month increments after that.
Okay.
There's going to be a floor, so it cannot adjust below a number. There's also a ceiling. It can't adjust above a number. And then there's also a first move. So the first adjustment, there's a cap on the first adjustment.
So it lets you kind of like glide into whatever it is.
There's a
Down or
up. Yeah, after that period. Now I will tell you, if you are seeking an ARM just to convince yourself that you can afford that payment, an ARM is not for you.
Would an ARM be for somebody that's like, I was going to pay this off anyway in 5 years?
Yes, in my opinion, the best strategy on an ARM, when ARM rates are back in line with like the risk that you're taking on them, which is you're actually going to get a little bit lower of a rate for it. What you would do, an ARM would be a great play for. I intend to pay this off in 3 years, 5 years. I don't intend to move, and I don't intend to hit the refinance, the need to refi. I have extra money, so I just wanted to lower rates so I can plow more cash towards principal.
Makes
That's
sense.
the strategy there. So the biggest mistake people make is taking that lower rate or that teaser rate and convincing themselves that they're doing that for affordability. That's how you get hurt on those.
Whoa. All right. Last one, conventional versus FHA. Oh, FHA.
FHA. Sorry, I should have wrote that in. Well, let's demystify one thing about FHA, because I've had this question 6 times last week.
Okay.
FHA does not stand for first-time home buyers, whatever A would be. FHA is a loan product that you can use multiple times in your life. There are situations where you can actually have 2 FHA loans at once. Not many of them.
It just so happens a lot of first-time home buyers do go that route, right?
Yes, and the reason being is FHA's minimum down payment in most cases,
I guess 3.5.
3.5%.
Okay.
It also generally allows for a 10% higher debt to income ratio than a conventional.
Ooh. Okay.
Other things where FHA is going to make more sense. If you've had a previous foreclosure, FHA's wait period is 3 years. Fannie Mae's is generally 7 years, unless you can document extenuating circumstance, and then it's like 4 years. You got to put 10% down. So there's some flexibility with FHA that you don't get on conventional. Why do agents and why does the market perceive conventional as better? Oh, FHA loans when we were real young and maybe before we were even born. So like FHA loans in our parents and grandparents' days, they were scumbag mortgages.
Ooh.
They are not that anymore. They are highly regulated. They are very, very easy to follow, super transparent. The reason sometimes sellers push against them or agents push against them is the property has to meet some certain kind of ticky-tack conditions like peeling paint and some maintenance type things. But Fannie Mae and Freddie Mac on the conventional side of the coin, Adam, they are now flagging that too.
Okay, so they're starting to come together.
Exactly. And why do you think that is? Is it maybe
it's probably an actual problem that needed to be addressed?
It's someone that works in the insurance industry, maintenance issues, property issues like decrepit or dilapidating roofs, obviously a big issue.
Yeah.
So now you have a house with a problem and you don't have insurance on it.
That's a problem.
That's a very costly problem.
Yeah, that's a financial sinker.
Yeah. So that's generally it. If you're looking at lower down payment options, FHA is a very valid one to consider. If you maybe have a 2-income household and maybe the spouse's income or the other person's income is not on paper, so you need that little bit extra wiggle room on debt to income ratio. It's a great one. Generally your PMI, that is the other part on FHA. It doesn't matter if you have a 620 credit score or a 780 credit score on FHA. You get the same PMI. It's upfront mortgage insurance premium. So a portion of the loan amount rolled into the loan and then a monthly portion.
Makes sense.
So that's about it.
Cool, dude.
To answer your questions there?
I think I'm ready for a loan.
Would you consider this an ideal conversation?
It was great. It was a good back and forth.
All righty. Well, we will be back. Actually, I'll be in Florida next week.
I'll be out of the country.
All right.
See you in a couple weeks.
Yeah, we'll figure out that next week. We'll have Tony Perri Sr. on in Florida, though. We're going to talk to him about short-term rentals and cap rates and all kinds of fun stuff. Until then, we're out.
Peace.
I'm done. Cut the show.